This week, actually kind of cool. So far we've done a handful of these and it's been fairly basic. We covered, like super basics, long calls, long puts, short calls, short puts, support, resistance, when to enter, when to exit, and a little bit on tuning your trading platforms. So this week, this is actually going to be the first time that we actually get into something that is more sustainable. I think for the most part, when people start trading, it's always, buy a call, buy a put, and then you get whipped around, and if you hold something more than a day or two, you're like, why is this thing just like bleeding out on me? So today we'll go over debit spreads, which is really like the first entry into more advanced trading. And so we'll teach you guys a little bit about what to look for, what are some general guidelines, how to set them up, and why they're better, right? So debit spreads. Before we do get started, I gotta read this, but before you start trading, go ahead and pull a copy of Characteristics and Risks of Standardized Options. There's a link to that in our disclaimer in the Discord. Quick review. This is that kind of copy of what we thought an option contract would actually look like, right? So we'll just go through and just remember. So buying calls is going to give you the right to buy the shares at a certain price and time. Buying puts is going to give you the right to sell shares at a specific price and time. Selling calls gives you the right to sell, and selling puts gives you the right to buy in the future. But what a debit spread is really, it's a combination of both. So we're going to both buy, we're going to do call options through this webinar, but it's going to be both buying the call and selling a call at the same time. So they're going to be on the same expiration or option series. You could do a put debit spread, but for debit spreads, they're long options. So you're going to buy something that's closer to the money and you're going to sell something that's further out of the money. And the combination really, it's pretty cool. So we go through, so we buy the right to purchase the stock at one price. Let's say Facebook closed somewhere around 300, a little over 300 today. So let's say I want to buy the right to buy Facebook in the future, but it doesn't actually go up forever and ever. And there's all these Greeks to worry about. So when you sell a call, you actually sell something against you. Let's say you bought a 330 strike call, and we're going to sell something higher. So the 330 is going to be closer to the money because it closed at like 310, something like that. And if we sell, we're going to probably sell a 350 call, which is further away from the money. If we thought it was going down, we'd probably buy like a 300 put close to the money, and we'd sell something lower further out of the money, like a 270 put. But here's the difference, right? So outright options, that's single leg options. So it's buying one option, and that's your whole position. So they do have limited downside. They're really good for managing risk versus like buying the stocks themselves. It's a lot cheaper just to do the options, right? The thing is, the Greeks get really complicated. So what's good about these is they have unlimited upside potential. And everybody's like, oh, I don't want to cap my upside. But if you're in the market now, you're actually probably realizing that stocks don't just go up and up and up and up and up, right? So if you've been a trader for a while, or if you know any trader that's been around for any considerable period of time, you can ask any one of them, but they will all tell you the first job of someone in the market is to be a risk manager first. Most people out of the gate, they'll get lucky and they'll hit like a lottery ticket, right? And what ends up happening is they tend to be more risk takers than risk managers. And the problem with that is that you can go bankrupt really fast, but you're not going to be able to stay in the game for any significant period of time. So what we're going to do is, by using a debit spread versus just a call option, we're actually going to show you a way to still be able to take those type of upside bets or downside bets, either way, and get the exact same return, actually even a higher return on your risk, but with a spread, right? So the real difference obviously. So here's the definition, right? A vertical spreads simultaneously buying and selling of the same option series, right? So same time series. So if it's a 1 week option, you're going to buy one option for May 21st and you're going to sell another option for the exact same date, May 21st. Different strike prices though. And if you use Thinkorswim, they actually have a default setting. They call it a vertical. For the most part, we call them debit spreads. So here's the real difference. So by buying and selling two options at the same time, you actually limit your upside potential, and it gives you the ability to own the shares within a certain price and time. So instead of just having, if you had a call option, you have the right to buy shares at a certain price at a certain time. If you have a spread, then you still have the right to buy the shares at a certain price at a certain time. But at the same time, you've sold the right to that right, but at a higher price. What we'll do is like you don't need a Tesla $5,000 call, right? Like you could totally sell that, right? Or anyway, just bad example. But we'll go through some. Another quick review, picking option strikes, right? So in the money, at the money, out of the money. All of this we went through on the debit spread webinar. We're actually going to use all of the same stuff. So before, this was like a straight line, but before, when we used a chart, and it would be an at the money call, out of the money call, in the money call, etc. It would just be one line that represents one price. With a spread, it's more of a box because you actually own the range. All the probabilities still stay the same. So in the money calls, 75%, like in the money spreads, we'll show you what that looks like. 75% probability of success. At the money, 50%. Out of the money, 25%. That's the one that a lot of people like to take. But if you can do it for a much lower cost, let's say half the cost, then you're actually reducing your risk by half. It's just a much better way to do it. In our signals, and even with some of the other traders, I think it was, Ryan is another trader that we have in the group who is a pro. He was looking at Target, and he was talking to me earlier. He's like, well, 220 call had a huge amount of volume, but you could do a spread. I think we'll go through it, but actually we'll walk through Thinkorswim. I'll open up the account and we'll go through some actual trades and maybe model some stuff. We'll have a quick example here. So this is an old one. So we used this trade as an example trade before. And I think one of the biggest questions I always got was, why would we entered a spread. You can actually look this up. This is somewhere available. I think it's published on TradingView and did an old alert. But so how do we get these 400+% returns? If you were to buy just an outright option, you're actually not going to get that same kind of return on such a regular basis. Most of the time for just an outright option, you're looking 200% max, maybe 250. But with the spreads, our rates of returns are going to be significantly higher. I think I can go through. Yeah. So buying calls, call spreads, and put spreads. You still have to know how much do I make and what happens if the price goes up or down. One of the first things that people have a hard time understanding is just how to understand what the profitability of whatever spread they're looking at is. So if it's, we say is like the long strike minus the short strike equals max value, right? So remember, we bought the right to own the stock. That's our long strike. We sold a different strike against it, and that gives us our range. So the range is called the width of the spread. So if it's a $10 wide spread, let's say the target one that they were talking about today was 220 call, buying the 220 call closer to the money, selling a 230 call further away from the money. 220 minus 230 is $10, right? So that's the width of the spread. $10 times 100, because each contract represents 100 shares. That's $1,000. So $1,000 is going to be your max value. So the width, however many dollars between your strikes, times 100, that's the max value of the trade. we were just putting this together last night, and I was looking at Facebook again, and we saw, okay, well, there was a 213 kind of top here early April, and it was coming down. This is the chart as of yesterday. I would have said probably not to take it yesterday, but today it actually looks really good. Before you open a position, right? So this is last night. Let's say you think it's going to bounce, and this little green box would be, this is what your position is going to look like. You can kind of come up with a pretty quick target. So the top of this green box is about 350. I don't want to hold it anywhere below 310. So this is going to be my trading zone, trading range. All right. So then what do I do? Do I do an outright? Can I just buy a $350 call? Do I buy something that's like 330? How far out do I go? Those are all things you immediately start thinking about. But when we start modeling it, one of the things you really want to look at is outrights or spreads. And then here's what you need to be really careful of. So remember, the Greeks matter in single leg options and multi-leg options. But for this one, the position is going to have a delta also. So if you're using Thinkorswim, the last webinar we went through how to set up your monitor tab. So because it's a multiple position spread, multiple option position, there's two different deltas involved. So what you do for delta is you take your long delta that you buy, subtract the delta that you sold, and then together that's going to give you the what's called position delta. When you're buying the spread, you want to look at what is that position delta going to be. Volatility is another thing that we actually need to pay really close attention to. When you're looking at spreads, if it's a super volatile stock, what happens is on a tight spread, and I say tight is like a couple dollars, anywhere below $5, you won't ever really get to that max value. Or let's say if it's a $5 spread, you won't get to that $500 probably until like the very last day of trading, right before it expires. Sometimes if you're looking at something and you want to give it some extra time, you would normally look at just buying an option a little bit further dated. But if you do a spread and you do like a $5 spread that's like 6 months out, you're probably not going to see any profits for a really long time, just because it needs to have that time decay start to kick in. Volatility too, because options get inflated one way or the other, it throws off what that max value ends up being. Volatility, definitely consider theta. Also consider all of these things. A little bit more complex with a multiple leg option position is you take your long option and you have to subtract whatever the Greeks are on the short option to give you your position option. Here's one thing. So remember, I have another slide. So this was a slide of how options actually decay at 42, this is about 45 days out, about 40 days out, options start to really decay, right? And closer that you get to expiration, specifically this 7 days to expiration, it just completely falls off a cliff. So we can actually use this to our advantage when we're building a spread, and we'll go through that. But just remember, so theta is important, probably one of the most important things. We're going to have a directional bias. So when we pick up the spreads, we want to have like an image in our mind of where is the stock going and where will it end at expiration within this spread. So here you go. So this was a screenshot I took last night, or June 18th, Facebook 330 call, trading for about $600. It's definitely a little bit more today, but this is the first time we're really going to show what this P&L graph is. And I'm going to pull some of this right here. This is your zero line. Zero line is what you pay, right? So you pay $6 times 100. So you pay $600. Anything below this line is a loss. And this really just represents at expiration. Down here, we went through when we're setting up Thinkorswim, these are the price slices. So at what value is my option going to be? So at $3,500 or $350, my one $600 option is going to be worth $1,400, right? So where do I see that in the graph? At 350, here's 350, right? Here's my line, $1,400. That's right about there. So this represents $1,400 at $350 a share. And it's the same thing, it's just a different way of showing it. But one thing, here's probably the most important thing to note, and what we went over last time. I bought a $330 call. This is $330. If I get to $330, what happens? I actually lose $600. Even if I get to 335, I'm still negative. So this is because of time decay. And this is like what, like a month, about that 45-day out period. Let's move forward. So debit spreads, right? Here's what we did. So we took the same strike at 330, and then we decided to sell a $350 call against it. So it's two separate options. When you bought the 330, you paid $600 for it. But when you sell the 350, you actually collect $200. So now let's take a look at this. Actually, when you do it, it's going to look like a single position, which is right here. So here's what this P&L. So remember this graph? It looks totally different. So what did I do? So I actually bought the same call, but at the same time, I sold my right. So remember, this gives me the right to buy 100 shares at 330. I sold that same right to somebody else for them to buy my shares at 350. So what does it do? It actually caps my profits right at 350. So that's why you have this little flat line up here. People might say, well, why would I want to cap my profits? Well, we'll go through it. What do you see the difference? So here at 350, right? For this spread, I'm going to make $1,600. Remember, this whole trade together is costing me 30% less because I sold that that higher strike. So over here, I don't even make as much. So what this is, this is actually what you see is when you don't cap your profit, you end up paying a little bit more, and your profits, this is a good profit. I don't know what this is, like it's over double, but we'll go through. We'll say, well, let's look at some other things. This P&L is definitely better than that. So remember, we looked at 330. At 330, I lose $600. At 330, I lose less. Why is that? It's actually because I sold that $200 call, right? And this is my total out of pocket. So if it gets up to 330, it's not going to be worth anything. If it gets to 335, though, this is where it gets kind of interesting. So remember, 335, I lose $100. At 335, I actually make $100. Definitely a better situation for sure. So how do you know what your spread is going to be worth? Actually, that's a good question. Remember when I was saying have a picture in your mind of where the stock is going to go as it moves forward in time. If I go, what do? We said 330 to 350. I'm just going to 350, 330. Cool. So this is my debit spread. Yesterday, it did not have this little green bar, and I wish I had seen it intraday trading, because dude, I would have opened this trade. Damn it. I might open it tomorrow. So I have this range, 330 to 350. And it's going to cost me $400. So I think, okay, well, if it bounces here, it's probably going to go up to here, and it's probably going to come down a little bit. And we hope to get somewhere in here. Here would be, let's call this 340. Yeah. So at 340, how much is my spread going to be? So I bought the 330 and I sold the 350. If this is right in the middle at 340, I've won. This is a $20 wide spread. So it should be about $1,000. So let's go back. I'm guessing at 340, it'll be worth $1,000. Perfect. So it's $600 plus our $400 that we paid. There's your $1,000. Does that make sense? So wherever it is in the spread, So if we're at 340, its value will be $1,000. So from 330 to 340 is $10 into the spread. It's 10 times 100, $1,000. Here's the cool thing. If it gets to 341, doesn't really matter. What's going to happen is, remember this 330 here, this is our long strike, and our short strike is 350. But if we remember, so time went forward, and this is at the money decay, at the money options. So time went forward. I started here, and let's say it's 2 weeks down the road. Now we're here. So the decay of my 330, because my 330 option was closer to the money, was a little bit low. As time went on, it started to get pretty high, and that was my whole spread. But now, if we're trading at 342, I have a 330 option and a 350 option. So if I'm trading right here, my 350 option is going to be closer. This is going to be more at the money. Sorry for this, really. And this one is going to be more in the money. So in the money options change, right? So the decay on in the money options significantly less than at the money options. At the money options, highest rate of decay. So what happens here? Actually, that long spread that you had, it actually becomes, and it won't show it here because it was at expiration, will actually become a positive theta spread. We'll go through and we'll find some more. So quick review. So this one, max profit, I risked $600, right, to make $1,400. Okay, cool. So that's a good return, but this is definitely a lot better. So what can we do? Maybe, what if you did 800, right? What if I did 2 of these, right, and change that to a 2? Well, this would be $3,200. Same percentage. In this example, $800, I can spend 30% more and make $3,200. This is what we do. So when you look at all of our alerts, they're all spreads of some flavor, whether it's a debit spread or time spread, which will be a later one. The reason we do it is because we can get a much higher rate of return doing this way versus what is easier, buying just a single call. Yeah, no question. This is definitely easier to buy one versus buying 2 options. But in the long run, this is almost double the return. So it matters, and it's super important to learn this kind of stuff. And again, like the very basics, I think just knowing the difference between the width of the strikes. Oh, I did put this line together. Okay, cool. So let's see. So this is almost what we just did. So yeah, so our short strike here, if you can get this to a point, if you buy something that's out of the money and you visualize in your mind, okay, well, if the stock goes here, you want your long strike to end up being in the money. And you want your short strike to end up being at the money. You really want to get up to as close to this short strike as you can. And even if it goes, let's say it goes completely through it, that's okay too. What happens here? Well, you get your max profit, which is max value is 22 grand, right? $20 wide times 100, 2 grand minus my $400. So that's my $1,600. You close the trade and you move on. There's no reason, like if it was really gonna go, do I want to have uncapped profit for an extra 30%, where really we spent $400 to do the spread. The single leg was $600. It's 30% less, at least. We'll call it that. That extra $200, it's not necessary. right? Because now that you've traded for a little while, you'll know that, okay, well, it's likely going to come back and then go up. Well, you can just open another one right here. And that's actually what we do. So this is an example. Oh yeah, this is a tighter spread. So you remember how we were saying, okay, if the short strike becomes closer to the money than the long strike, that's it. Is the short strike closer to the money than the long strike? That's how you set this up. Nothing more to it. This one, so 310, this is yesterday or last night. Last night, $0. Facebook closed at 315. Perfect. Okay, so this is a $5 wide spread for, so remember, shorter spreads, tighter spreads. This is $5 wide for a shorter period of time, 1 week, do better for short dated options. 310 to 315. This is very far in the money. The value should be $5 times 100, right? So it should be $500 value, but it's trading for $300 as of last night. So this is going to tell me, okay, I have actually a $200 profit if what happens? If the stock goes nowhere. All this has to do is close at 315. So if we had another kind of chop day, if it went down to 314, if it closes the week at 314, I'll actually make this spread will be worth $400 because 310 minus 314, $4 times 100. That's how it's going to be worth $400. I'd still make $100. Does that make sense? I'm closing. The value of the short call go up as it does. Yeah, so it totally does. The value of the short call, great question. So we're selling this, right? 315. It will go up. But what's important to us in a spread is the net value. So let's go ahead and pull this up. Okay, so this is live, right? So today, well, Facebook went up. So we were modeling buying a 310 and selling a 315. Well, now it's trading for 375. So what did it do? You know what? I wanted to show you guys this before. There's this linking. Click red. Facebook. Charts. Now it's automatically the same. So today it opened at 315, closed at 320. Okay, so it went up $5. Yes, the answer to your question is yes. This short call totally went up. But guess what? So did the long call. And so what happens is because this call is further in the money, you look at this delta, right? Remember delta is how much. So this delta, this goes up rate of $81 per $1 move, when this delta goes up at a rate of 68 cents for every $1 move. So yes, this short call value goes up and it looks like it goes up against you, but the long call goes up faster in your favor than the short call goes up against you. And so the net result is 375 is a win, right? So yesterday this was trading at $3. Today it's 375. Wow, this bid is what's after hours, so the bid ask is pretty wide. I mean, shoot, if I can get this out at 4:30 sometime tomorrow, I mean that's a pretty good win. And it's trading at 320. Actually, if I could buy this completely in the money now, selling at 315, buying at 310, if I could buy this today for 375, here, we'll go to analyze. And we'll set this up just like we had a second ago. So today is the 6th, right? Check this theta out. So remember theta and delta. So this together is the position delta, position theta. We haven't gone over these gamma and vega yet, but we will later. Today it closed at 320. So we'll just look at 320. If I move forward, let's say we have a week. So this is Friday, tomorrow. It's at 320. If nothing happens and it closes at 320 tomorrow, okay, well, I make another $6. Simulated price right here is going to show this at $380. If it goes down, do I win or lose? If it goes down to 318, no, 313. 313. Yeah, I do lose tomorrow. But let's move this to expiration the day before. If it closes at 313, which is $7 lower than it is today, I lose 75 bucks. If it closes exactly where it is today on next Thursday, this is Thursday the 13th, right here. The expiration is the 14th. So it closes on the 13th. Exactly where it is today, I make $80. If I were to just buy, let's say, the 315. So I'm going to uncheck this, and we're just looking at the long 315 call in the money. If I just bought the one call, this is probably distracting people, so I'm just buying the same call, 315. You know what? We'll make it the 310. If I just buy the 310, well, it's going to cost me $1,200. I don't think anybody here would do that. Just doesn't look good. If it goes nowhere, I lose 160 bucks. If it goes down, I lose a lot. That's almost this is $1,200. That's, I don't even know what percentage that is. That's like go cry in the corner percentage for sure. If I bought the let's go back. Let's call this the 315. It's a little bit less. Okay, if it goes nowhere, I actually lose more. I'm just gonna put these together real quick. So the 310, and goes nowhere, I lose 160. 315 goes nowhere, I lose more, $225. So why is this happening? Well, this is all the Greeks, right? So look at this theta. So this 315 has a negative theta. I have to pay 60 bucks a day, and it changes, right? So this is today. Today, if you were to buy this 315 call, you're gonna pay 20 bucks a day just to own it. That's crazy, right? Well, let's say if you wanted to go deeper in the money, you're paying less. It's 310. You're paying, even if it goes up to 340, you're still paying to own this every day. $1.30, $4. As time goes forward, moving forward one day. See how this theta is changing? Watch this 30. We'll go backwards. This is today at 320. Let's watch at the money. Actually, let's make this clean. 320, 325, 330, 335. 305. Cool. I think we can all visualize that. So at 310, today it closes 320. I pay 18 bucks a day to own it. Tomorrow is Friday, so I have to pay Friday $18, Saturday $20, Sunday another $20 until we get to Monday. That was what, $60? $60. It moves nowhere. Wow. There it is. There's my P&L. I did nothing, and I lost 130 bucks. That sucks. 315 is actually worse, right? So you lose a little bit more, you pay a little bit more. 330, 315. So here's what we're doing. We're actually gonna sell this. So we buy this, we sell that, and boom, what happened? We have a positive theta. We're getting paid every day to own this combined position, because the decay on this 315, if you were to buy it, is higher than the decay on the 318, on the 310. completely in the money spread. You can open, actually, you know, sometimes you can find these on some really wide traders like Shopify. Shopify, what? 1090. Let's say, I don't know, 1050 to 1010. This is a four, let's go 1000. There's 800. So I can tell right away, because this is $50 wide. It should be worth $5,000. It's trading for 42 right now. I know that there's basically $780 worth of decay left in this trade right here. At the money, 580, or let's go. Even this $5 wide is trading for like half. This should be worth $500 if it closes right there. Tomorrow's Friday. So they call it expiration Friday for a reason, because you can actually find these right now. $5 wide, $300. This is crazy. This should be worth $500. Nobody's gonna $600. But you can find these all the time right now, especially on a Friday. You know, $5 wide. Look at that. If you pick this up for $200 in 24 hours, the decay is going to be 300. That's insane. Let's see. I wonder if I can find. Let me get back to this deck that we have. Cool. So, if the short strike is close to the money than the long strike, closer to the money than the long strike, that's how you want the position to end up being. If you're going to buy it with some time, you want the stock to basically work towards your strikes and land right in the middle, closer to the short strike than to your long strike. Yes, the short strike will go against you and it looks negative, but at the end of the day, you own the position, you own both of them, the long and the short, and at the same time, the total position is going to be going definitely in your favor. And it's all the same kind of principles. So near the money options have less decay initially, but the closer they get to expiration, the faster that decay ends up being. So when you're building your own spreads, remember, I think what I'll say, and we didn't go through this, what I will say, I totally should have put that. I think some of the guys know that the easiest rule of thumb, I was told rule of thumb is like a sexist term. I had no idea the other day. I had to change all this stuff. If you're going to buy a call, let's say we want to do this 320. Let's say we want to go out here to, what is this, May 21st. And I think it'll get to 325. So you could buy that. Well, a lot of people buy at the money. See this volume? They're buying at the money, and we'll do this all the time. And they're selling out of the money now. So if you were to use the chart, it's 325. What are they doing? 325 and 330. Perfect. This is that range right here that they bought. They're actually expecting this exact move. They want it to end closer to the money of their, they want their short strike to end up being closer to the money than the long strike. That's perfect. I actually really like that trade. So the not the rule of thumb, the thing to remember is 1/3. So if I want to buy a call and it's about $690, so 320 call, 690. Actually this is going to give me, at the money gives me a 50 delta 99% of the time. Doesn't matter how far out you are, 50 delta at the money. 50 delta. What is this? Half a year out, multiple years out, 50 delta, give or take. Always going to be 50 delta at the money. And we want to sell something like a 25 delta here, which ends up being 28. Look at that. almost exactly 25 delta. So this position, 50 minus 25, should give me a 25 delta trade, right? That's the happy medium. That's the sweet spot. And it's going to hopefully close closer to my short strike. Easiest, quickest way to do that, 600 bucks, 700 bucks here. I want to look for something that's about a third of the price. So maybe a little over 200 bucks. Boom. Buy, sell, a little over 200 bucks. It always ends up being just like this. So you want to sell a call. That's about 30%, give or take, of your long strike. And that's going to reduce your risk by about 30% just because of the money that you're putting out. 600 bucks, 700 bucks is a lot to put out for a trade right now. This is a lot too, but it's actually it's a lot more palatable to me than almost 700. And this position delta here is 50 minus 28. 28. If this goes through, here we'll do this, analyze. Here's why you want to do this. Right now, let's say you pay 420 bucks. The position has a negative theta at today. Small negative theta for net. $5 I pay per day. Here's the one that we want to look at, 325. So this strike, that's where they're targeting, that it's going to go above 325. So look at these three, right? If it gets to 330 tomorrow, so this is tomorrow. Tomorrow, I'm going to have a positive theta on the trade. My delta, here's the trade-off, is starting out around 25. It's actually going down just a little bit, and I'm trading the extra delta for some extra theta. If that makes sense. As I get closer, it's a good trade though. As you get further out in time, so 510, let's get, yeah, 510 is Monday. Perfect. Let's go Tuesday. This theta, it's still paying me. My delta will start increasing. Pretty cool, huh? So see the trade-off? A little bit less payment. If I go forward, it ends up being 28 delta. This is a really good trade. Why didn't we alert this trade? Anyways, at 330 bucks, let's say if I hold it, this is the 13th, I'm going to make $257. My position simulated is going to be worth almost 600, 800 bucks. Let's say if it closes on the 14th, 15th. Wow. Oh, wow, this is May 21st. I got a lot of time on this. Let's say we go out to 21st, day of expiration. Okay, expiration delta becomes 100. I pay 420 bucks today. It's going to be simulated price to value, right? $10 wide, value $10. I'm going to make 570. That's 100%. That's a pretty good deal. That makes sense. And so for 400 bucks, shoot, I could have done two of them. Yeah, make 1,200 bucks, 1,100 bucks. That's a good deal. I take it, especially with the chart lining up the way it is with this candle here. This is called a bullish engulfing candle. It's a very good, very, very good sign. Kind of upset that we didn't open it. But anyways, that's about everything on these trades, I think. So we'll go back to the deck over here. Okay. So check the position, delta and theta. We just did it in the monitor tab or the analyzer tab. Small spreads for shorter dated options. Anything further out, wider is better. So if you want to go, that spread we just looked at was $10 wide for about 2 weeks. It's right in the sweet spot. Anything further than 2 weeks out, probably want to go a little bit wider. And if it's less than 2 weeks, $5 is actually a really good and a happy medium where you can get something that hopefully will close completely in the money. That's your best case scenario. That is it for those. I think we're good. One thing I did, well, this is the old simulated. So remember the monitor tab. This is monitor tab. We were just in the analyzer tab where it was telling us our position, delta, and theta. This is why we set up that monitor tab that way. You can always look, how much is it worth? What is the position? Whatever the position was, this is something that, I don't know, expired. It'll tell you your position delta of the trade and your position theta of whatever that position is, right? So if you had this set up this way, like we went through last week, you know how much you have at risk, you know how much you're going to pay every single day to own that, and you know how much your upside or downside exposure is. Right here, this is, I'm going to read this as a synthetic equivalent. So it's like I owned 3.72 shares of whatever this is, AMD, and I'm going to pay $2.42 every day to close it. Well, I don't like this, so maybe I'll just I'll change this to cool close if it gets any lower, and that's done. Other than that, I think we're good, guys. Have a good one. Adios, guys.